Hey there, dividend growth stock investors. It's Colby, the DGI Crab, and I thought I'd provide you all with an update on a couple of ETFs that I certainly like, VYM and VYMI. We've gotten through the first 3 quarters of the year thus far, and just recently, VYM and VYMI both announced their Q3 dividend payments. So I thought this would be a good time to take a look and see where we are standing with those and how they are performing this year as opposed to last year. As always, this is not financial advice offered here on this channel, as I'm not a licensed professional. You should always do your own due diligence before you invest in anything. All right, so here are the numbers. So we've got, the way I've organized this is we've got our tickers, VYM and VYMI. Here's how they have performed through the first 3 quarters of 2023 compared to 2024. And what we can see so far is VYM has had a rough first quarter, down 6 cents from the previous year, rebounded in Q2, was up 14.7 cents. And then just recently here in Q3 performed 6.65 cents better for a grand total so far of 15 cents more in dividends through the first 3 quarters of 24 than in 23. VYMI, the international dividend ETF that, as you all may know by now, is far and away my favorite international ETF. In fact, it's the only non-US stock holding that I have. I put 5% of my dividend investment dollars into VYMI every single time that I invest to make sure that I've got that international exposure, and it has not let me down so far this year. Q1 was massive for VYMI. It paid out more than 30 cents more in the first quarter of 24 than it did in 23, and then fell off in the second quarter with 17.7 fewer cents than the previous year. And then this past quarter, Q3, it did just about 1.5 cents better than it did in the previous year, and it is up 14 cents so far over the first 3 quarters. So both of these are up almost identically from a percentage perspective. Both have increased their dividends by better than 6.3% so far for the first 3 quarters. Now for Q4, if both VYM and they're 78.46 cents, and VYMI 68.26 cents, if they could just match those exactly, which they won't be exactly, they're going to be a little bit off from those, of course, but if they can deliver right about the same amount, both of them are going to be up better than 6% on the year, which is just fine with me, actually. For VYM, it would be right in line with expectations. Typically with VYM, you're going to get an annual dividend increase somewhere between 5% on the low end to maybe 8% on the high end. And the closer to 8%, the better, because typically with VYM, when you purchase it, the starting yield on cost is going to be usually somewhere between 2.75% and 3.25%. So usually right around 3%, give or take. So if we can get an average annual increase above 6%, that's a pretty nice dividend combo factor. It's putting us right near 10% overall dividend growth. And then with VYMI, if we can get a 6% dividend increase from VYMI, we're really cooking there. Because with VYMI, your starting yield typically is going to be about 4%, if not better. It's been yielding more like 4.5% so far this year. Now, both of these are up. I mean, pretty much the whole stock market's up right now. So our starting yield on all of this stuff is on a little bit on the lower end than what it sometimes is. But hey, if I can get a 6% dividend increase out of either of these two ETFs, I'm going to be very happy with that, particularly from VYMI, because those international dividends, if you look at the dividend history of any individual international company, they don't have that same level of consistency as US companies. So if I can get that ETF with a starting yield of 4% or better and get 6% annual dividend increases on average, that's just about as good of an international investment as I could ever hope to make. Because for me, I don't want to have to pay attention to what's going on with the Canadian economy or the French economy or the British economy or the Australian economy, you name it. I've got enough to keep track of with my 60 individual dividend growth stocks based here in the United States and what's happening in our own economy that could affect those individual companies or individual sectors to worry about what's going on in the international market. So good news for both of these ETFs so far. They are performing better than they did in 2023. Both of them, their share prices are up compared to where they were in 2023 as well. But this channel is all about adding qualified, in most cases qualified, tax advantage dividend income. That's what you're going to get with both of these ETFs. And if you're not of a mind to do research on individual companies and individual stocks, and you just want to dollar cost average into some ETFs to consistently grow your passive income, you could do so much worse than either of these two stellar options from Vanguard. So that's all I've got for you today. A little bit of a quicker video, but I don't think there's any problem with that. You guys don't always need me rambling on for 10 plus minutes at a time. But I just wanted to deliver some good news out of these ETFs and congratulate the shareholders on them, because you are seeing your dividend income increase year over year without having to do so much as lift a finger. So Vanguard's earning their money from you on those. They both have low expense ratios and they're performing quite nicely. So I'm happy for Vanguard to make that little chunk of money that they make off of me on those ETFs. They're earning it, absolutely. All right, so everybody, as always, there are going to be links in the video description below to other helpful videos on the channel. One specifically regarding ETFs and which ETFs I like to purchase based on the age of the investor, as well as links to videos on each of the 4 tiers, where I break down each of those 60 individual dividend growth stocks that the channel focuses on and explain why I believe that each stock is appropriate for that particular age range. So hope you all are having a great week so far. Let's keep piling up that passive dividend income.